Hello again, everyone. Thanks to everyone who stayed with us in the Venture Suite, and welcome to everyone who's joined us from the other rooms. So one of the interesting things about this showcase is it showcases opportunities from all over the world, but also we shouldn't forget some of the best opportunities can be right here on our doorstep here in the UK, and that's certainly been the case in recent years when UK equities have been very lowly valued. But we thought we'd do something a bit different for this panel. Rather than just talking about how UK equities are lowly valued, which I'm sure we'll talk about a bit, we thought we'd invite three managers whose strategies are a little bit different from other UK equity managers to talk about how they're looking to take advantage of the opportunities in the UK market. So we're joined by Dan Whitestone on the end from BlackRock Throgmorton Trust, Stuart Widdowson from Odyssean Investment Trust, and Lucy Walker, who is the chair of Aurora Investment Trust. But before we zoom into all their individual strategies, I wanted to start with that sort of scene-setting question about UK equities. So we've been told for so long that UK equities are lowly valued. If I had £1 for every time I've been told that over the last few years, I would be a rich man. And they're lowly valued versus Europe, let alone the US. Now this year, I sense that there has been a bit of a recovery, but it's not sort of broken through into the public consciousness yet. It's not really turned into a sense of real optimism. And why is this? Why is it taking so long? And are you seeing any signs of a more substantial turnaround in sentiment towards UK equities? Stuart, if I could perhaps start with you.
Nick, it's an excellent question. I think we were all quite excited in May, actually. One of the things we look at as a bellwether of interest in our sector is the number of units in the Vanguard FTSE 250 tracker. And it had been flat as a pancake for about 18 months. And then suddenly, post end of March, people started to put money in the FTSE 250 trackers. And this is normally a really good lead indicator of positive sentiment, because I think everybody, certainly that we speak to, sees the valuation opportunity, but no one's doing anything about it. So this was like the first example. And then it's all gone flat. And you could almost time it to the point, if you look at these flows of the general election. And I think the interest was there, but it's a bit like the wind's been taken out of the sails with some of the uncertainty around the election. I think also the uncertainty around what the budget's going to bring.
Okay, thank you. Dan?
Well, to avoid all saying the same thing, I mean, look, another lens to look at is we had 33 consecutive months of outflows in UK small mid-caps up until March or April, and that amount is about 16.5 billion. It is, no matter how great a fundamental story is, if you're constantly facing persistent selling pressure, it's very hard for the equity to progress. And so I really thought, like Stuart said, as a turning point, I thought post-election we had another little bounce, and I thought this could be the start. And unfortunately, this awful negative drum roll of negativity in a 22 billion black hole, every time I open the FT, it is so depressing. We have snatched defeat from the jaws of victory. And so I really hope this budget will be a clearing event. But ultimately, people need to have confidence that this government, if they're going to change debt metrics, they have to be confident that if they are going to raise more money, where does it get spent? Is it spent on giving more money to public sector wages? Is it spent on vanity ESG projects with no return invested capital in a lifetime? Or actually, is it going to go into the real world or local economy where you can see a multiplier effect in putting cement in the ground and driving genuine local or micro economic improvements? And that could be very, very powerful. Because the inflation argument, I really believe, actually, is being won. I think rates can fall from here. And if so, you don't even need fresh capital from Europe or US coming into UK. The first thing you'll get is reallocation of capital within the UK from many large cap fund managers running local authority mandates who ultimately sought sanctuary in the FTSE 100, really for risk management reasons. Remember, 10 shares are half that index. They will instantly start moving back down the capital stack into small mid-caps, and that'll be the first leg of buying, which could really power some very, very cheap equities that you've mentioned.
Excellent. Lucy, I know you're an optimistic person. Can you give us any optimism?
Tough one. Hopefully, I think the budget will be clearly the the big moment where we get to see whether, the optimism that we all started to have earlier in the year is actually founded. I don't have enormous confidence at this point on that specific point. But I think, if we look at a trust like Aurora, actually we don't need a market recovery to generate great returns. So I guess it's kind of separating out the two. Clearly, a great economy is a positive, clearly, but I think actually when you're thinking about the kinds of companies and the kind of return on capital and the returns that you're going to get irrelevant of a re-rating, we don't think quite so much. And I say we in a grand sense because I'm, as Nick said, I'm the chair rather than the fund manager like these two gentlemen. So slightly less close to it, but certainly it's a kind of separate thing, considering whether the economy is directly linked to the returns that are being generated in Aurora.
Excellent, and that seems a very good jumping off point to talk about your strategy in Aurora, and indeed we'll come to the other two as well. So what do you do differently in the UK equity space? Yeah,
so definitely different to the other two panellists in the sense that we are an all-cap strategy. So we have some small cap exposure, but we also see incredible value across the cap spectrum. So that's everything from sort of house builders through to kind of UK consumer stocks and low-cost airlines. So there's a real kind of mix of exposure. But the real differentiator, I think, if I consider what Phoenix, the investment manager, is doing differently to the rest of or many other managers out there, they are incredibly long-term to a point of which it's virtually kind of unfounded. 6% turnover in the last few years. That kind of figure is one that you rarely see as low as that. In fact, some years they've not bought anything in an entire year, and that's not because they're not doing anything. That's just because they haven't seen the value. They'll only act when they really see opportunity, and then they are incredibly disciplined when it comes to their kind of research process and what they're buying. So if you look at the amount of analysts that they have per the number of companies, it's incredibly concentrated, and they only have a very small number of stocks per analyst. In fact, right now, I think it's actually one analyst per stock, which is virtually, probably not many other investment managers that have that. In their 26 years of existence, they've also never bought any research off an investment bank. Which again I think is really unusual. So it's this incredibly long-term, incredibly disciplined, incredibly in-depth analysis, and they don't care whatsoever about volatility. They care about permanent loss of capital. And so that research, that in-depth research that they're doing, is all about making sure that the companies that they're owning are going to be growing. They prioritize investing in growing markets and then companies that are growing within that, but then also management that is not going to waste it, because you can buy a high return on capital business, but if you have management that are then going to waste all of that on acquisitions, then you've basically lost it all or a chunk of it. So those are some of the hopefully that gives you a flavour of some of the ways in which I think I spent my career as a fund buyer. I met investment managers, fund managers, every day of the week, and I can say that the setup at Phoenix, based down in Barnes, I always joke that their office is the one, when I walk along over the Hammersmith Bridge and I walk along the road to get to their office, I know when I get there because there's just a huge bin outside, and that kind of gives you an indication that they don't care about looking really fancy. They just care about investing in really great businesses that they want to own forever. And actually, when there are takeouts, which there have been a couple in the last year, actually they're quite annoyed, because normally those fantastic premiums are actually not as much as they thought they would deliver over the long term.
We'll try not to see that bin as a metaphor for the UK market.
Yeah.
Okay, thanks very much, Lucy. So Dan, would you like to go next, talk about your strategy? Because it is really quite different, I think, from all the others.
Definitely some differences here. Okay, so Throgmorton, there's different levers that we can pull. Effectively, it's a gross of 130%. So for most investment trust long-only funds generally are, there is no gearing. And so for every pound they spend, I can spend £1.30. And I don't have to spend £1.30 in just buying things that I think can go up. I can also, through synthetic instruments, actually short companies too. And over the last 10 or so years, I think I've had 7 or 8 companies that have gone to zero. That I've shorted, not that I've owned. Big success this year with a UK-listed semiconductor company, JV in China. Lots of big bookings, no cash flows. And we love getting into the accounts. I've known Stuart for years. We often share these panels. We both have a shared sort of passion for getting stuck into to various nefarious things that can happen. So that is one lever that we can use to try and exploit to generate more alpha, because for all these great success stories, and there are multiple companies in my portfolio that have gone up 10, 20, 30 times in the 10 years I've been there, or some of these investments predate my arrival at BlackRock. But there's also lots of bad actors out there. And we want to find those, prosecute those, and short those. I could also go beyond the UK. I can allocate up to 15% of my exposure in non-UK small mid-cap companies. Just to be clear, everything I'm talking about is listed. There's no private investments. But I can also take advantage of good opportunities in Europe and the US. And yeah, I prosecute that whole mid-cap, larger small-cap part of the market. That's really my key hunting ground. But the core philosophy, I think it's probably maybe fairly similar to the people on this panel, is to build your portfolio around companies that are generally like differentiated and advantage. And already people start rolling their eyes thinking, oh, it's another glib statement. No one goes out and says they buy horrendous companies. But quality obviously can be measured in like quantifiable terms like return on capital employed, etc. But we always start with the management team. We want to buy into that vision. If you have any chance of competing as a small mid-cap company, you have to be differentiated and advantaged. You'll be crushed by the capital deployment of a large-scale incumbent, or you'll be crushed by the marketing budget of a large-scale incumbent. So the only way of being true is to have something special. So we spend so much time analysing, therefore, the durability, sustainability of those gross margins. We look at how much they're spending in R&D, what return they're generating, what percentage of products come from new products developed in the last few years, so you can see the flywheel of money going into the business and coming out the other end to keep generating that high organic revenue growth. And you work your way down the P&L, these companies that can beat the fade on organic revenue growth generally see margin expansion and just grow ahead. And you combine that financial strength. This is how you avoid putting lots of capital. You just buy companies with strong balance sheets. And then if it's an operational mishap, okay, it's a bad day for the share and equity, but ultimately you'll get it all back and more. It's a great investment if it's got a core financial underpin. You know, Stuart knows this. I started my career strategy consulting. It's never busier for us than dealing with companies that are in trouble. And I'm telling you right now, when you're the CFO and you've got a lot of leverage, your only priority is to generate enough cash flows every single month to make your interest payments. So don't sit there and pretend to me that you're really thinking strategically about, right, how can we invest in PPE? How can we invest in R&D? How are we going to move into a new market, open a new product line? It's nonsense. Financial strength is absolutely underpinned. Find out with great companies, great products, and own them for the long term, and you will have some shares that will multiply through time.
Excellent. Thanks, Dan. So we've got just a very concentrated strategy with Aurora, an all-cap strategy. We've got a long-short strategy here with Dan. Stuart, how is your investment company different?
Well, I think there's elements of actually both Dan and Lucy's trust. So we have a high conviction strategy. We're super concentrated. We have typically up to 20 stocks. We operate in companies typically the market cap between 100 and a billion. So small cap and bottom end of FTSE 250. And we have a portfolio of almost special situations. We only make 3 or 4 new investments a year. We only look at TMT, services, healthcare, and specialist industrials. So there's whole swathes of the market we don't own. Very similar to Aurora, we're very well resourced. As 3 of us look after 16 stocks. So again, we like to try and get to know the companies that we invest in really, really well. We do all our own due diligence. We don't rely on the sell side. We call customers, competitors, suppliers. We use LinkedIn loads for doing that. And the key thing that we think we're really good at spotting is not the growth stories that are going to make 10 or 20x that maybe Dan would be focusing on is excellent at finding those. We think we're really good at finding niche market leaders that are underperforming their potential. And we spend a lot of time looking at companies, what operating margins and return on capital they're making today versus their potential. And we're looking for change points where actually, good company, undermanaged, somebody good comes into that company, and a bit like a bad manager, pushing on a ball in the bath. Bad manager pushes the ball down, get a good manager in, let the hand come off, and that ball will generate you return that's not really correlated to the market. So really that's what we're all about, is finding what's fundamentally a good business that's been historically undermanaged, that could get better and hopefully make money out of that. And what we tend to find is they do improve, and alternatively they re-rate and become the stocks that are cleaned up and Dan might buy, or alternatively they get bought by trade buyers. So very different.
Excellent. 3 very different strategies, although some common strands actually, which is also interesting to see. I've got one more question for you, and I'd like to move to questions from the audience, both online and in the room. one of the criticisms of the UK market is that it's focused towards sort of low growth, high dividend paying sectors. We don't have enough in tech, etc. And we always sort of beat ourselves up about that, make comparisons with the US. Do you think these criticisms are fair? And if so, how do you sort of avoid these issues? Lucy, can I start with you?
Sure. I mean, yeah, we don't have as much tech in the UK. I'm actually a founder of a tech business, but not in the FTSE. Not yet.
Not
anyway.
yet.
Yeah. But yeah, it's definitely the case that some of those views are founded, right? You know, we can't change the structure. I mean, obviously, we can hope that the government starts to do policies that encourage that to change, but that's not going to change overnight. So I suppose that actually what the UK has in spades, I mean, previously buybacks were pretty much, well, not nil, but certainly pretty low. That really has changed this year. We've seen, I think it's 40% of the FTSE 100 and even into the 250, we've seen some buybacks. So I think that you're seeing companies recognise that there are ways in which they can, I suppose, benefit shareholders in a way that is not just dividends. And certainly, you know, we in Aurora see fantastic opportunities for companies that are growing. As I said earlier, they're in growing markets, they're growing companies. You know, it doesn't need to be the case that we have, you know, fantastic tech companies. Aurora, much like the other two panelists, is a value company. It's a value trust. You know, we're probably not even going to be investing in, you know, the companies that are incredibly highly valued. We're looking for companies, you know, the classic Warren Buffett thing about, you know, do you buy company A that's great but expensive, or do you buy company B that's good but cheap? You know, Aurora would definitely buy the latter and not the former. So I don't think those views are necessarily unfounded, but I also don't necessarily think that's a problem.
Okay. Stuart, would you like to come in here and maybe also think about, you know, the dividend culture we have here in the UK? Is that, you know, wholly a positive thing, or does it have its negative aspects as well?
Look, I think what's really missing is risk appetite. And this, as Dan said, really from the big pension funds. So if you take a step back, the changes to advanced corporation tax, UK pension funds, I think, used to own, someone correct me if they're wrong, something like 55% of the UK market equities, and they're down to, I think, single digit now. And that's been a massive amount of capital that's been taken away from the market. So that's led to de-equitisation, de-ratings, and on top of that, you've had wealth managers who have, for one reason or another, decided they want to go into global equities for all their clients, although there is some evidence that that's started to change or reverse a little. So the question is, what do people want from UK equities? Well, I think we strongly believe that people invest in equities because they want growth. You know, they don't just want to maintain their wealth; they actually want their wealth to grow. And dividends is one way to do that. But actually, over time, you tend to get better capital growth in growth companies. It's not always the case, but it can be the case. I think the issue is making sure that the companies that we have, where they have those options, whether or not they're going to pay out dividends or they're going to reinvest, that they're well managed and well stewarded. Because actually, if you have a good business model with a good return on capital, why wouldn't you reinvest a reasonable portion of that revenue to continue to grow? I think the challenge at the moment is actually a lot of companies, probably in the last decade, have been overpaying on dividends.
Right. Dan, any thoughts on this?
Well, it's probably good you went with my colleagues first, because you get a more measured response than the opinionations of me. Like, there are some structural issues at the FTSE 100. I mean, we've got to delineate between FTSE 100 and 250, small mid-cap, and AIM. And obviously, there's differences in both. There are some fantastic companies in the FTSE 100. The problem is that 10 companies dominate half the index by value, and the technology sector is less than 1% of the all-cap. So there is a structural embedded problem in the composition of the index. It's not going to change in the next 5 years, okay? And the worrying trend that's developed ever really since Nelson Peltz helped orchestrate the move of Ferguson, or Wolsey, as many people in this room will know it as, from the UK to the US. CRH is now doing it, Flutter's doing it, or done it, Smurfit Kappa are going to do it through WestRock. You're going to see, obviously, a swathe of US-focused international earning companies listed in the UK move their primary listing to the US, and you're going to hollow out the FTSE 100. That's a problem. But, well, certainly in our case, I'm not pitching the FTSE 100 ETF. I'm here to talk about small mid-caps, a market that persistently reinvents itself. Okay, consumer, industrial, financials are effectively 80% of the index. Some great, fantastic export services companies in there, some niche industrials. It's a great, diverse universe that has been through difficult times before, often written off unfairly. And yes, it's definitely had a difficult time. I mean, small mid-cap, forget valuations. Comparing the valuation of the FTSE 100 versus the S&P is a redundant exercise. Who cares? The competition is completely different. Why would I compare the PE of Lloyds and Shell to the PE of Meta and Nvidia? It's crazy. You can look at, obviously, companies versus their own growth rates versus history, future, and versus their listed peers. And you can certainly look at the valuations of small mid-caps versus large caps. And we've had the deepest, longest drawdown of valuations dispersion between small, mid in the UK and large. That will not persist. It really affects everything we've spoken about, higher interest rates, a move up the capital curve into security. That will change as rates come down, more capital will flow back into equities, and that's why you've already seen in the last few months a broadening out of returns from 7 shares in the US to now many more shares in the US across different sectors hitting 12-month highs. That's where it starts, and the capital will work its way down, and Russell 2000 will move, and small mid-caps will move. And if you just look at the long-term performance, I can't quote the numbers to you, but if you go into my presentation on the BlackRock website, we show you, going back to like 1950, when records began, small mid-cap index versus FTSE 100, the outperformance is not a little bit, it's not a lot, it's staggering. So small mid-caps over the long run, I think, are a really compelling place to invest. Thankfully, over the long run, we have, I've nearly doubled the return of the index in relative outperformance over the last 10 years. We've outperformed and outperformed the index, even though the last few years have been tough work. And I really believe this universe will reinvent itself and has a much better chance of reinventing itself. And when you see so many companies on trough valuations, on near trough earnings, of really strong fundamental stories, buying back their equities. I mean, buying back your shares is not an investment strategy, okay? You can't make money out of that in the long run, but it can certainly help keep you in the game while you wait for things to turn. There's some really good companies out there, and at the moment their share prices are not being rewarded. It's right that the economy isn't relevant to many companies' revenues and profits, absolutely true. But the economy is relevant to sentiment, and sentiment is relevant to flow, and flow is relevant to valuations. And if we don't fix that, or it doesn't fix through time, then someone else is going to take advantage of that. And that is why this year we're seeing elevated levels of M&A, and that debate will be around, is it the right thing setting out now for a 30-40% premium, or actually is it better off saying no, showing a strong hand, and seeing actually what could this company deliver if we just let it run its course over the next 3 to 5 years with an improving earnings base and getting the re-rating and valuation to the valuation it deserves based on its returns, its profile, historic and forward-looking in growth. You'd agree with that, wouldn't you?
Absolutely.
Yeah.
Wonderful.
Come on,
Thanks, Dan. That's music to my ears. I've
Yeah.
got a lot of small caps in my portfolio, so I'm pleased to hear that trend is going to reassert itself soon. Any questions from the audience, please? Yes, please, on the front row. Could you just wait till you get the mic before you ask the question, please? Thank you very much.
Right. Thank you for that. The budget is on everyone's mind at the moment. And I just wanted to ask that there's a very strong likelihood that the Chancellor will remove the benefit on AIM shares, the business relief for inheritance tax, people who are planning inheritance tax. And it's predicted that AIM shares can drop as much as 30%. So what are the managers doing about that? And especially in your case, Dan, you can short AIM stocks, and are you doing that?
Okay. The first thing I'd say, in aggregate, I think UK small mid-caps are incredibly cheap. So I'm not shorting that much at the moment, certainly versus my own long-term history. There obviously are a few isolated idiosyncratic cases I mentioned in past the semiconductor company, but generally I'm not doing much in shorting, and I'm certainly not going to short something on a good company on a hope that it may fall on a founder selling ahead of a budget or something like that. But what you're talking about is happening right now, but it's not just that. Okay, people are selling. Speak to any wealth manager out there. People right now, the phones are ringing non-stop in the last 4 weeks. Everyone is selling stuff for capital gains tax ahead of the budget, and people are selling because they're terrified about this pension tax relief being taken away, which would be a terrible decision. Okay, so the reason we've had this huge leg down in the last 4 weeks is 3 sources of selling. It's IHT concern, devaluation. It's any share that's got a big founder on the register, because obviously every day I'm getting a phone call from someone wanting to sell down shares. And so they're all falling in sympathy. All three, it's around pension. So we've got to move past this moment to the budget. So I'm not really trying to prosecute or get involved exactly in that area, but I can explain to you that is what's causing the leg down. And then it's all about what happens after the budget, and we've got to find out. Like, none of us know exactly what's going to happen. Capital gains tax, I mean, it's 350,000 people, so like, it probably affects pretty much everyone in this room. But it absolutely doesn't affect mainstream. You know, you walk around the school gates, like my kids' comprehensive, like, you're not going to see them all up in arms about, you know, capital gains tax going up. I mean, unfortunately, though, it's a problem because you're not going to go and buy a small mid-cap share if capital gains tax is 40% probably. It may really make you think twice. So these are sort of things that we've got to like watch out for. But there's been so much negativity. I just think at some point in this panel, we've got to try and get, like, there are some seeds of like positivity, which I never actually addressed in my first question. So I know it's not what you asked, but just give me 2 minutes and I'll shut up and someone else can talk, okay? House building, big part of my fund, definitely a big part of your portfolio. It's one area, believe it or not, seeing improvements. We are an inflection point. House prices are up, rolling 3 months, first in 4 years. Inquiries, mortgage approvals, they're all up. Affordability actually is improving. Transactions are going through. And this is an area, by the way, where housing output is at a 20-year low. And if supply actually, if they would deliver on one thing in terms of housing supply and planning permission, that could be a phenomenal midway, runway in the medium term. There are definitely, I know people get focused about consumer confidence, took a knock. It's really irrelevant. It's so skewed by the Daily Mail, Guardian, FT, whatever journal you look at. Household cash flow, as to income, much more reliable. I had a meeting the other day with CEO of Tesco. Their data on the consumer is unparalleled. If you want to find out what's going on, go out and meet some real companies and ask them. And by the way, they have data also on the US consumer and on China through Dunhubby. Okay, so their views are very interesting. They're actually seeing consumer confidence. It's actually pretty high. People are actually trading up. It's a much better picture than perhaps we might all think. May not last, but there are definitely signs of an improvement. If we can just get through this budget and it's not a complete catastrophe, and hopefully we can get back to like thinking about what can happen going forward. And let's go back to talking about some great equity stories and let's see them being rewarded, as opposed to us talking about the great equity we've got in our portfolio, delivering great results and beating their forecasting and raising their guidance. And then you sort of look at them and think, right, but you're, 9 times earnings or 10 times earnings and free cash flow of 10. Like, what is going on?
But perhaps I think you might have emailed me on this exact question on AIM. We were talking about it actually just before we came in. Ratings and AIM companies have fallen actually quite substantially in the last 5 weeks. Going back to what Dan said, the liquidity of them is not fantastic in some cases, and people are voting with their feet. They're assuming the buying has stopped and the selling has been dripping. So I think if they do change it, it's not going to be positive very short term, but I think some of that's already priced in. The flip side is they're already quite cheap, and I think all you need is 1 or 2 of them to attract bids, and the market will reassess it. So I think that's one outcome. I think the second outcome, we've only got really one company that is probably more exposed to AIM than others, and we've already engaged with them to suggest that maybe they might move to a full list rating, because AIM companies, if you don't know, they don't have index funds as shareholders. If they do move to full list, it might be one way of finding new buyers that don't exist today. But we're absolutely on top of this and looking at how we engage with portfolio companies and what we do about it. But it's unhelpful uncertainty.
Absolutely. Thanks, Stuart. Lucy, any comments on the budget or AIM in particular?
I think it's been done to death, so yeah.
It's been said.
Let's
okay,
move on.
Lovely. Let's get some more questions then. So we have one question over there at the back. Thank you very much.
Yes, can I just ask, you've been talking a lot about the mid-cap sector and small-cap sector reinventing itself. Obviously, a lot of equities coming out through takeovers and share repurchase. Are you seeing anything coming in, i.e. the quality of IPOs seems to be poor, if there are any?
There's very, very little coming in. But this is not a UK small mid-cap phenomenon. There are no IPOs happening really anywhere. In Europe, in the US, large cap or small cap, so it's definitely not specific to the UK. My point about reinventing itself is it does over time, but absolutely at the moment, companies are going, we're obviously a net loser of companies with heightened M&A and people delisting. But I do think that if we can move to a world that's slightly more optimistic than the world that we're in right now, I do think that things can change very quickly, and certainly investment banks have a huge pipeline of companies or IPO, but it's not much about the quality, it's about whether those founders of those companies actually want to list in this country right now, and do they think they'll get the commensurate valuation that they think they deserve, particularly if there's a listed comparable in a different stock market. And so I do think the IPO market will improve, not just here and everywhere else, but I think we probably need market juices to, I don't know where I'm going with this, but to improve, and that would hopefully be the start. Over to you.
I'm naturally quite a contrarian. I'm quite optimistic about the medium-term outlook for IPOs, and why? There have been so many companies taken off the stock market. There aren't that many left, actually, and the selling is virtually extinguished. And given the liquidity of these companies, you don't need much in the way of margin new buying to drive potentially quite substantial re-ratings. If you go back and look at Q209, as we came out of the GFC, small cap went up 36% in a quarter. And then the next quarter it went up, I think, 38%. So in 6 months, the index went up 80%. And these companies re-rate, and then IPO becomes more interesting because actually fund managers have had inflows, they need to deploy capital, and on top of that, the ratings and the valuation you'll get as an IPO, someone wanting to IPO, is actually more attractive. I think the interesting corollary for me is almost like the mid-90s. There was a lot of PE activities, a lot of PE-backed IPOs. And I think the opportunity now is we're not going to go back to zero interest rates. Zero interest rates has been a massive competitive advantage for private equity in the last decade. Whereas now, IPO, I think, is potentially, looking forward to that, a much more viable exit strategy than maybe it has been for, I think, probably 8 to 10 years. So I'm optimistic. I think we'll have more companies on the stock market in 3 years' time, and Dan and I and Lucy's colleagues will have a lot more choice.
I'm enjoying thinking back to 2009. And the other thing we should point out about 2009 is that investment trust discounts narrowed very dramatically in that year as well. So for investors in investment trusts, there's a double whammy effect. Lucy, any comments on this question?
I think it just the comments that were made earlier about the kind of the divestment in UK equities, for global investors, basically nil. For UK pension funds, it's virtually nil. The potential for more and more selling is just diminishing by the month. The outflows from UK small cap have been multi-year. Well, so have they from UK all cap as well. So these trends are just absolutely massive. But obviously, we believe, or certainly Aurora believes, that these things, they don't last forever. So I would fully agree with the kind of the optimism in actually it really doesn't take much for that to turn. And to, I can't remember who said it, but the point that actually we are actually seeing the beginnings of reversals in that sentiment in terms of UK ownership. So the kind of the wealth managers that previously had 50%, certainly 40% in the UK, that's probably now 4%. I'm hearing anecdotally that is increasing, and these are the things that you then need to, to get to the more optimistic viewpoint on IPOs. So yeah, it's not going to happen overnight, but I think it's definitely something that we should be looking forward to.
Lovely. Any more questions? Any from this side of the room? Oh yes, we've got one right over here.
Thank you. 2 questions. Stock lending. Do any of you guys do this? And also, if you are optimistic about the future of the market after the wonderful budget we're all waiting for, what's your gearing policy?
I can just go first on that to say nil and nil.
Nice, straightforward answer.
Okay, we don't stock lend. We use the investment trust structure to allow us to invest in a very concentrated portfolio. We've never had a gearing facility, but we have the lowest cash balance that we've had for a long time.
Dan?
Well, I work for BlackRock. We manage, I think, 11.5 trillion. So the stock lending one, I don't know, because it might be a part of BlackRock that does. So I can't give you an answer on that one. In terms of gearing, I can go, obviously the gross is 130. The net can vary from less than 100 to 115, 120. At the moment, I'm around sort of 106. So modestly net long, reflecting the inherent value there, but at the same time, keeping some dry powder to go again if there's more induced volatility, which could take another further leg down to go through it. Conversely, if things turn quickly, It's definitely a possibility where you could see the gearing of the trust go up quite quickly.
Okay, a question at the back there, please.
Mr. I beg your pardon, Mr. Whitestone. I'm a shareholder in your investment trust and have observed with some dismay its slide during the course of this year, where others have improved. You are blaming, to an extent, the animal spirits within the market for this. But would it be a sound strategy, perhaps, to select companies that can sustainably grow and hopefully grow their share price, irrespective of the condition of the market?
Well, that's an excellent question. We absolutely start by trying to find companies that we think can sustainably grow, but we need to distinguish between companies that are growing and share prices that are rising. So, we've got a portfolio full of lots of companies that have done phenomenally well this year, last year, the previous years. Some of them, in cases, the share prices just aren't reflecting what they're delivering, and there's different reasons for that. It's not like performance is down to lots of individual investment cases going horribly wrong. I mean, by the way, if you invest in small mid-caps and you have like an 80-share portfolio like we do, you do every year have some mistakes. So there definitely have been some stock-specific mistakes in the trust this year, but no different to any other year in the 10 years that I've managed it. So, we are, I think, ahead of the benchmark this year. Well, we also not think we are ahead of the benchmark this year. We were ahead of the benchmark last year. I've only had 1 year I was behind the benchmark, which was 2022, and been ahead of the benchmark every year before that. So I said, over the benchmark, I think I've almost doubled it, almost, not exactly, but almost doubled it in 10 years after all fees. So, I think that's, you can only do that if you've got a portfolio of companies that can deliver and be rewarded. But frustratingly, I think for many of us, they haven't been rewarded to the extent that we would like. But if we're right and things get better, then, if you buy great companies, you can afford to be patient, and time will come. And at some point, there'll be big periods of performance, as we've seen historically.
Thank you. Any more questions? Okay, yes, we've got a question in the middle, right in the middle here. Thank you.
This panel is about alternative investment and specifically about UK equities. So what is your view now going forward for UK listed precious metals?
Okay. Anyone would like to go first on that?
I will certainly be giving that one a pass.
You have no investments in that?
Nothing in precious metals.
Stuart, anything?
We don't do that. No.
No, same here. I only invest, like Stuart, I only invest in 6 sectors of the stock of the market, and then that's not one of them, I'm afraid.
I guess the question would be, why not?
Oh, I'll try and answer that.
I'll just go first to say that. So Phoenix, the investment manager of Aurora, they have this incredibly detailed depth of research that I mentioned earlier. And part of that is that they invest only in companies that they can actually understand. And so they need to be able to monitor, they need to be able to dig into delve deep into the all of the moving parts of a company. And so therefore, unfortunately, that sector is one that they have never, and I don't believe will ever, invest in.
Yeah, very similar to us. I think our view is the major driver of success in investment of the kind you mentioned is the commodity price. No one can predict that. Therefore, we can't evaluate it.
As my colleagues just said, I think in fund management, it's difficult to be all things to all people. I think it's what's more important to have a very clear philosophy. You need to understand what your strengths are. I've spoken about the unique characteristics that lead to long-term enduring success, and I generally think you find those investments in consumer services. One person's view, okay, it's a PE of 1. But you generally find them in consumer services, industrials, specialist financials, technology, profitable healthcare. That's like industrials, that's really where I invest in. I think when you start going into other areas because they're popular or whatever the reason, we don't have an edge, I think it can lead to bad performance, and it's even more difficult to explain why you're underperforming. So I really think you've got to narrow your universe down and stick to the areas that you think you have some idiosyncratic or stock-specific advantage on.
Thank you, Dan, and thank you for the question. And if you are interested in precious metals, if you come to the Venture Suite after the lunch break, we're going to hear from Ruffer Investment Company. I know they have a 6% holding in gold, so I'm sure they'll be able to perhaps give you a different answer to that question. We don't have time for any more questions, I'm afraid. So I'd like to thank the panel very much for giving us such a frank and optimistic view on the UK market.